Hey everybody, special edition of Hash Rate today. We're going to do the a16z State of Crypto Rapport. So I read it cover to cover. This is the third one of these that they've put out. They started it 2 years ago. So the first one when it came out was during the height of DeFi summer, and they basically were rather gushing about DeFi, which grew from 0 to 200 billion in TVL in about a year. So they remarked that they'd never seen a market grow that fast. And of course, in the subsequent years, we saw the dump from FTX and, and Luna and all that stuff. So that dropped off significantly to around 50 billion. So it got chopped into about a quarter. And this report sort of covers the recovery of that trend. So let's dive right into it. All right, here we go. The State of Crypto 2024. They talk a little bit about the sort of summary of what's in here, but I'm going to kind of skip through that because I want to dig into each one of these things individually. So let's start here. Crypto activity and usage hit all-time highs. So there have never been more monthly active crypto addresses. In September of this year, 220 million addresses, crypto wallet addresses, interacted with a blockchain at least once. And that figure has more than tripled since the end of 2023. So they defined active addresses. Yeah, so as a metric, active addresses are easier to game than other measures. So they acknowledge that, maybe this is kind of bullshit. But it's one of the best yardsticks we have nonetheless. So here's what it looks like graphically. You can see internet users. That's the green line there. Versus monthly active crypto addresses. That's the orange line there. And I've seen this expressed in other places. You can think of crypto as sort of being where the internet was in terms of raw number of users in the late 90s. And it is roughly tracking with, and in some cases exceeding, internet adoption. Crypto adoption is what I mean by that. So the explosion of this activity is due primarily to Solana, which accounted for about 100 million active addresses. So there's a lot of new activity on Solana. This was followed by Near with 31 million active addresses, Coinbase's popular L2 network Base with 22 million addresses, Tron with 14 million, and Bitcoin with 11 million. Of all the EVM chains, the most active after Base was Binance's BNB chain with 10 million, which makes sense because, BNB was the first blockchain to really give us hyper fast, hyper cheap transactions on an EVM chain. And they kind of cheated by doing that by centralizing it, but nobody kind of cared. People were just after the performance, which is sort of the story with Solana as well. And they make a little note here that the EVM chains were deduplicated by public key to calculate the 220 million total. So what they mean by that is that if you were using the same address on Binance chain that you use on Ethereum, they don't count that as two wallets. They count that as one wallet because it's using the same address. And there's a lot of duplication throughout EVM space. I know that I use the same wallet on as many as 10 or 20 EVM chains. So that deduping is a pretty significant thing. Yeah, so here's what the breakdown looks like graphically. You can see Base at 22 million, Solana at 100 million, BNB chain at 10 million, Ethereum at 6 million, Polygon at 5 million, Arbitrum at 3 million, Optimism at 1 million. And then you have sort of the also rans below that. My little favorite Phantom here at 4K, but they're doing their Sonic upgrade in December. So I expect that. I honestly, my personal opinion is I think that's going to just explode because Phantom has now found a way to give Solana-like characteristics to an EVM chain while retaining true decentralization. And I think as more sort of parties clue into that, we're going to see Phantom move up this chart. I think by this time next year, we're going to see that much higher up on this chart. A16z also introduced something called the Builder Energy Dashboard. And this is a kind of nice graphical representation of where developers are interested in developing on what chain. I don't know how they get this data. They're A16Z, so, they have their methods. They don't reveal how they got this. But it is, Andreessen Horowitz's perception of the interest among builders. And they view that as a key metric to see where success and money will eventually flow to. It's a pretty good metric. I agree with that. So Ethereum is still king of the roost there with 20.8% of the developer interest. Solana is now second at 11.2%. And sort of looking at how that used to be, Solana was at 5.1% last year. Now it's at 11.2%, so roughly doubled. Base saw a pretty big jump also, moving up from 7.8% to 10.7%. And here's one of the big surprises, Bitcoin, which bumped up to a total share of 4.27% from 2.6% last year. So on a percentage basis, the interest in developing on Bitcoin has almost doubled. And that's not surprising, as we've seen a lot of new innovation on Bitcoin just in the last year and a half. We first saw BRC20s, then we saw ruins. In recent weeks, we've seen Unisat and Binance launch the Fractal Bitcoin Layer 2 chain. We've also seen things like Merlin. We've had stacks around for years. So there is a growing interest in creating DeFi on Bitcoin and putting EVMs like OpNet is doing onto the Bitcoin, the raw Bitcoin native blockchain via a meta protocol, which is sort of similar to a BRC20 in that they use indexers exterior to the Bitcoin network to sort of keep state of an EVM. That's how OpNet does it. I'm hearing about a new Bitcoin layer 2 or another way to put smart contracts on Bitcoin every day. This sector is heating up very fast. I think by next year also we're going to see that up quite a bit. On an absolute basis, Ethereum is still attracting the greatest share of total builder interest at 20.8%. So Ethereum has yet to be dethroned. They are still king of the roost. Meanwhile, the number of monthly mobile crypto wallet users hit an all-time high of 29 million in June of 2024. So I guess that means, people that, on their phone have MetaMask or whatever, they use it, I guess, at least once. And there's, 29 million people who did that in June of 2024. The United States makes up 12% of the total mobile wallet user base. And that has declined in recent years as crypto adoption has grown globally. So there's more people in other countries using mobile wallets, which makes sense. And more projects seek regulatory compliance by excluding the U.S. through geofencing. So there's a lot of companies now that will not service U.S. customers because the SEC has, been very antagonistic to the industry and also unclear about what they will attack and what they will not. So a company has great risk if it services U.S. customers, unfortunately. So you see a lot of notices that say things like, you can use our product, unless you're in North Korea or Iran or the United States. So we are now, the United States is lumped in with the kooky countries. But I don't blame companies for doing this because they could suffer significant harm if they serviced U.S. Customers. It's just unfortunate. And hopefully that's going to change pretty soon. So here's what it looks like graphically. Mobile wallet use hit record highs driven by growth in countries such as Nigeria, India, and Argentina. So in this graph here, the gray area is unknown, it's just other. But this blue area here is the United States, so we're still sort of the biggest. And then this right here is that is Nigeria. So a lot of mobile wallet usage in Nigeria, and then this sort of saffron pinkish color here, I guess it's not really saffron, it's more pink, is India. So India has also seen quite a bit of growth. So here's a little statement on how they calculated this. While it's easy to measure active addresses in monthly mobile wallet users, it's much trickier to measure the number of actual active crypto users. Without revealing how they did it, a16z says, we've estimated that there's somewhere between 30 to 60 million monthly active crypto users worldwide. So that proportion represents only 5 to 10% of the total number of 617 million global crypto owners, and that was estimated by crypto.com. So what this is saying is there's 30 to 60 million people that use their wallet once a month, to do something, to move a coin, to do a trade, to stake it in Ethereum. They do something once a month. So, but there are the total number of people that own crypto is 617 million worldwide. So that's, 5 to 10% of the total number. So most of those people are just letting their coins sit in their wallet and they're doing nothing with it. So that's a pretty big opportunity to re-engage passive holders on chain. So if you give them something to do, a lot of those people might start interacting with blockchains more frequently. Okay, so this is the same figures represented graphically. So there's the monthly mobile active wallet users. Here's the total number of estimated global crypto owners. So, teeny tiny percentage of them do something once a month. Okay, point number 2. We're only on point number 2. Oh, before we leave point number 1. So why do people in developing countries use crypto wallets? It's important to recognize that in places like Nigeria and other regions of Earth, getting a bank account is hard, if not impossible. So having some way to custody your funds is extremely valuable, and everybody's got a mobile device these days. And more specifically, if you can custody stablecoins on that wallet, there is no way in Nigeria you can go get a bank account and custody dollars. Like you can custody the Nigerian currency, but you can't custody actual dollars. But if you have a crypto wallet, you can custody Tether or USDC. You can actually own and keep dollars, which, if you're in a country where the currency is massively inflating, that is extremely valuable, right? So you can basically, the dollar's still inflating, but it's inflating a lot less fast than most other countries. So that is one of the reasons why crypto wallets have proliferated so wide and so far and so fast. Hash Rate is sponsored by Ledger. With the announcement of Ledger Flex and Ledger Stacks, Ledger gives you the best security on the planet for your crypto and identity. Ledger Flex and Stacks drive an e-ink screen with the same secure chip that's in your credit card and passport. Except, instead of protecting the secrets of banks and governments, Ledger protects your secrets and your private keys. Ledger supports Bitcoin, Ethereum, Solana, and more than 200 other tokens. The secure touchscreen, plus the Ledger Live app, means that whether you're buying your very first Bitcoin or doing your 2000th swap, you can do it securely and easily with your Ledger. And as always, use my link, shop.ledger.com/hashrate in the show notes to get the very best price whenever you buy a Ledger Flex or Stacks. OpNet is the ultimate solution for deploying smart contracts directly onto the Bitcoin blockchain, leveraging its security and stability. As a meta protocol, OpNet allows you to run Ethereum-style smart contracts on any UTXO-based blockchain, including Bitcoin and fractal Bitcoin. With OpNet, there's no need to rewrite your existing smart contracts from scratch. Simply deploy them on OpNet, and you're live on Bitcoin or fractal with no modifications required. Start your journey on OpNet today by visiting opnet.org. Okay, takeaway number 2. Crypto has become a key political issue ahead of the U.S. election. So, crypto has broken into the national discourse this election cycle, with Donald Trump speak at Bitcoin Nashville and speak extremely positively about Bitcoin. Say he's going to fire Gary Gensler. Like, stuff like that has never happened before in any other political cycle. So we measured the swing states' relative levels of crypto interest. 2 battlegrounds expected to be among the tightest races in November. Pennsylvania and Wisconsin have seen the 4th and 5th biggest jumps in crypto search since the last election in 2020. So let's go have a look here. So there we go. So we've seen, this was 0.53%. Michigan is 0.33%. Wisconsin up 4.7%. So that's, those are kind of big swings up. One factor that could have raised people's interest in crypto this year was the listing of Bitcoin and Ethereum exchange-traded products. Now, one little note here, the a16z crypto report refers to ETFs as ETPs, and technically they are correct. They are exchange-traded products, even though everybody and their brother, including me, refers to BlackRock and everybody else's Bitcoin products as ETFs. That's actually technically incorrect, even though it is the popular way to phrase that. So if I say ETP, it means the same thing as ETF. So the Bitcoin and Ethereum ETP or ETF approvals have broadened investor access to crypto. So before the ETPs, there's a lot of people and a lot of funds that could not actually get access, could not custody, could not own Bitcoin or Ethereum because the charters of their companies just prohibited them from owning anything other than stocks or kind of approved financial products. Once an ETP or an ETF put like a traditional financial product wrapper around a pile of Bitcoin, all of a sudden they could own it. So that means that there are very big dollar customers that can now own Bitcoin effectively through owning it via an ETF. So the total on-chain holdings when this report was written, 58 billion in Bitcoin ETFs and 7 billion of Ethereum ETFs. So both pretty respectable amounts, and we expect those to grow significantly in the coming years. So this is this represents a major crypto policy milestone. This is a big deal. If you listen to Fred Krueger, this is the biggest thing that's happened since the birth of Christ, right? Like that's literally how he views it. It's incredibly important to Bitcoin's future. There's a lot of Bitcoiners that are like, I don't like the ETFs, but I gotta side with Fred on this. Getting mainstream adoption and traditional financial products, packaging Bitcoin is a big deal. And we're also seeing an increasing number of policymakers and politicians speak positively about crypto on both sides of the aisle. So here's kind of the lineup here. Now, I kind of view Kamala and Schumer as disingenuous, mostly because while both of them were in power, Gary Gensler of the SEC has famously attacked crypto without providing any sort of guidance on what's a security and what's not. He basically says, come in and register, and then you get a Wells notice the next day, right? And and nobody really knows when it's coming or why. And the arguments he produces in courts change from case to case, so it's inconsistent. And it's just not clear, how to be compliant with the SEC. It's actually many parties, including Mark Cuban, have said it's impossible. So I view the statements by these parties who are in power now, who are in charge of what's happened over the last 3.5 years, is sort of like Cat saying, if I'm reelected as Cat, I promise not to eat mice. They've been eating mice savagely for 3.5 years. I don't think they're going to change. I think they're just saying what they need to say to maybe get elected. On the other side of the aisle, you have Trump, who has been extremely pro-crypto. He spoke at a crypto conference at Nashville, as I said, as did Kennedy, who's now on the Trump team. You have Cynthia Loomis, who has fought vigorously for pro-crypto regulation and has been very vocal for a long time. Same thing with Emmer, and the same thing with Scott. So I think you can take these statements to the bank. These are incredibly pro-crypto people. I actually view Representative Ro Khanna as also very pro-crypto. He's sort of stuck on the left, but he is actually very progressive and a very smart dude. I actually believe him, so I take him at his word. All right. Blah, 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 blah. So there's been a couple wins. I'm going to go through here. Okay, stablecoins. So stablecoin regulation. So stablecoins have become one of the most popular crypto products. We're going to do this breakdown later on of, what is working in crypto, where the product market fit is, where the usage is. But stablecoins are one of the biggest ones. And as such, they're also one of the biggest topics for policy discussion, with several bills already floating around Congress. So one of the big points to realize here is that stablecoins strengthen the U.S. dollar's position as the global reserve currency. So you're seeing a lot of news now about BRICS nations meeting to discuss an alternative reserve currency to the United States dollar, something to oppose the United States dollar, coming out of Russia, China, Brazil. They're basically looking to dethrone the dollar as the king of the heap. But if we have dollar-denominated stablecoins circulating in Nigeria and other places, and if they're very treasured, that projects U.S. strength. So Congress realizes that stablecoins are a good thing. So 99% of stablecoins right now are denominated in USD, which dwarfs the next largest competitor, which is the euro, at 0.2%. So, but that could change if the United States outlawed stablecoins. You'd probably see a lot of rogue USD stablecoins, but you probably would also see an increase in other national dollar stablecoins. The euro would certainly rise. There would be other, maybe one of these, maybe BRICS would put out a stablecoin which would gain traction. And, over the years, you could see that dethrone the dollar because the dollar, didn't play ball with crypto. So, the politicians realize that this is something they need to embrace. So here's another interesting statistic. So in addition to projecting the power of the dollar around the world, stablecoins are potentially strengthening the country's financial footing at home. Despite being only a decade old, stablecoins have risen to become a top 20 holder of U.S. debt, putting them ahead of countries like Germany. So here's the graph. So these are basically countries and entities that hold U.S. Treasury securities. So these are foreign holders. So Japan's at the top. They hold the most U.S. debt, right? China is the next biggest holder of our debt. The U.K., Luxembourg, Canada, blah, 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 Saudi Arabia, South Korea, Mexico, and then stablecoins. And so that basically means right now Tether and USDC. So Tether has $81 billion worth of U.S. Treasuries. USDC has $11 billion. So basically, if the United States dollar is sort of a Ponzi. We all kind of know this. And that Ponzi is like all Ponzi's, propped up by more people buying in at the bottom. And in this case, the United States, the US dollar Ponzi is propped up by people buying treasuries, right? So you basically give them dollars, and then 6 months, a year, 2 years, 5 years from now, you get 5%, you get 10%, whatever it is, on the amount of money that you locked up with them, right? So, and where do they get this money? They just print it. So which like all great Ponzi's, right? They just print to repay the previous parties. So, but it's a great way to make money, right? As long as the United States dollar is around, it's a fantastic way to make money, especially if you have giant scale. So Tether has done this by taking the dollars that they are required to keep in a bank account and earn money through treasuries. So they're actually making more money in some quarters than BlackRock by doing just this and having something like 50 employees. But the United States, it's actually helping to prop up the dollar because you need people at the bottom of the Ponzi buying in, right? So if Tether is continually buying more and more dollars or more and more debt, that's great for the United States dollars. So they've become systemically important to the continuation of the United States dollar. And as time, as it grows, you'll probably see stablecoins and Tether in particular move up this chart somewhere, around where Canada is, maybe as big as China and Japan, at scale. So we'll have to see. Okay, point number 3: stablecoins have found product market fit Okay, number 3: stablecoins have found product market fit. By enabling fast, cheap global payments, among other uses, stablecoins have become one of crypto's most obvious killer apps. So the proliferation of dollar stablecoins, rendered possible by the ubiquity of smartphones and the cryptography of blockchains, could become the greatest experiment in financial empowerment humanity has ever taken. That's Representative Richie Torres of New York. And he's a Democrat, so good for him. So, so here's basically why. So if you want to send money via wire, it's $44. You want to send it via USDC on Ethereum, it's $12. If you want to send it via USDC on Ethereum now, so this was around 2021, it was $12. Now the average gas price is $1. So it's it's got chopped into a 12th. But if you do it on Base, it's less than a penny. So this is compare $44 to less than a penny. Holy crap, right? So plus what I mentioned earlier, in many countries you can't even custody United States dollars in a bank account because you can't get a bank account and the bank account doesn't support dollars. So being able to custody dollars on your phone is a very, 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 very big deal. Being able to send it to anyone in any amount for less than a penny instantly is also a very, 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 very big deal. So can't be overstated how valuable both of those things are. So stablecoin transactions amounted to $8.5 trillion in transaction volume across 1.1 billion transactions. So 1.1 billion individual transactions, but $8.5 trillion got transferred in this, I guess, the second quarter of 2024. So that's just one quarter. It's not even a year. So stablecoin transaction volumes more than doubled Visa's 3.9 trillion in transactions over the same period. So Visa moved 3.9 trillion. Blockchains and stablecoins moved 8.5 trillion over the course of a quarter. So stablecoins, even in sort of their infancy, which they really are in their infancy still right now, are just absolutely crushing Visa, both in terms of performance and in terms of volume. So here we compare the stablecoin supply by issuer. Most of this is Tether. This blue area is Tether here. This is USDC right here. So USDC is sort of the silver to Tether's gold, if you will. And here they're comparing stablecoin volumes and number of transactions. So PayPal is, $500 billion. Stablecoins, 8.5 trillion in dollars. And interestingly, PayPal had more transactions, 6.6 billion to stablecoins, 1.1 billion. There's Visa. There's ACH. So this is just, bank-to-bank wire transfers. And that this is FedWire. So FedWire is still the biggest, 284.2 trillion in volume. But very, very few transactions. So this is for, very large dollars value transfer. 284 trillion. All of crypto right now is at around, I think it's at around 2 trillion. It's been as high as 4 trillion. So we got a long ways to go before we even have the amount of crypto required to start facing off against FedWire. But you get an adoption curve that goes exponential. You could actually hit that faster than you think. Stablecoins are not a fad. If you compare stablecoin activity against crypto's volatile market cycles, the two appear to be uncorrelated. So if you look at this little black line here, that's stablecoin activity. And that's just a straight up, up and to the right kind of thing. Whereas this blue area, this is activity in crypto. You can see it surges in 2021, DeFi summer, all that. Blip, 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 FTX crash, Luna. And now we're seeing it sort of grow back, but it's sort of the early stages of a new bull market right here. So activity, what are people doing with crypto? So stable coins are roughly a third of daily crypto usage at 32%. So it's not quite as much. So here's stable coins right here at 32%. It's not quite as much as DeFi. So DeFi is the biggest killer app for crypto. And a lot of people, sort of dismiss this. They think that DeFi failed after FTX and Luna, but nothing could be further from the truth. DeFi is quite healthy and has in fact been growing back pretty healthily just over the last year or so. As I mentioned earlier, at its height, it was about $200 billion worth of total value locked. It crashed down to, below 50 billion in TVL, and is now hovering at around 100 billion in TVL just over the course of like the last 6 months in 2024. So DeFi is got a pulse, and while you were sleeping, it's been growing back. Stable coins are the second biggest use case. Infrastructure, so things like bridges, oracles, miner extractive value, MEV, account abstraction. It's kind of a mishmash of stuff in there, 14%. And then 13% are token transfers. So just, people sending each other tokens other than stable coins. So, I send you ETH, I send you Bitcoin. That's, all those sending and receiving is about 13% of it. Centralized exchanges like Coinbase, et cetera, 3%. Gaming at 2%, NFTs, 1%. Social networks, less than 1%. So, we might see these sectors grow in the coming years, but it's still kind of unclear. All right, point number 4, infrastructure improvements have increased capacity and drastically reduced transaction costs. So one of the reasons why stablecoins have gotten so popular and easier to use is due to underlying infrastructure advances. So for one thing, blockchain capacity is growing. So blockchains are processing more than 50 times as many transactions per second as they were just 4 years ago, thanks to the rise of Ethereum L2 networks and other high throughput blockchains. So basically blockchains have gotten very good at assisting Ethereum on the layer 2s. And then blockchains themselves have been able to handle much faster and higher transaction volumes, faster block speeds. Just the whole thing has gotten exponentially better over the last couple of years. So Ethereum's biggest upgrade of the year, Proto-Dank Sharding, or EIP 4844, significantly reduced fees for L2 networks after its implementation of March of this year. So the fees paid by L2s on Ethereum have plummeted, even as ETH-denominated value on L2s has continued to rise. So, blockchain networks are getting more popular and more efficient all at once. ZK proofs. This is something I don't know a lot about, so I'm not going to spend a lot of time here. But bottom line, ZK proofs are improving, and there's more than 250 crypto projects actively working to advance ZK technology. So there's quite a bit of interest in this particular arena. The idea is that if you can get ZK proof, powerful virtual machines up and running, that can be one of the holy grails of crypto. You can see, though, it's still kind of, oh, look at that. They're stuck in 1971 in terms of their processing power. So, it's ZK knowledge virtual machines have a long way to go. It remains unclear as to how fast or when or if they'll get there. Okay, so DeFi, blockchain infrastructure, and DePIN, we haven't talked about DePIN yet, we will, are some of the hottest categories in 2024 for builder activity. So DeFi, 24.8% of builders are building something in DeFi. Blockchain infrastructure, 19%. Picks and shovels, I actually don't know what that is, but social networks. So even though it's less than 1% of the activity right now, 10% of the builders are actually trying to crack, putting Facebook or Twitter on the blockchain. Wallets and identities, physical infrastructure, so DePIN, 6.5%. This is a pretty hot area. So think of something like a decentralized Amazon Web Services. So a collection of a bunch of machines in people's homes or even in data centers that are receiving crypto payments in exchange for usage of their machines. And in aggregate, all of those machines that are participating in this network add up to something which is greater than Amazon Web Services, perhaps in terms of processing power, but definitely, even today, drastically less cost. So it's a fraction of what you'll pay on Amazon Web Services if you use one of these DePIN infrastructures. So things like a cache, for example, AKASH, is one example of a physical infrastructure DePIN network that is competing directly with Amazon. So a cache is definitely one of the leaders. I'm a big fan. Tau SETI is another one. And a lot of these are focused, or at least specializing on AI, because that's where there's a lot of demand for GPU and where they can make a lot of money. So they're crossing the chasm initial market. Gaming clocks in at 6.3%, blah, 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 a bunch of other stuff. NFTs are sort of fallen out of favor, but even they are still sort of seeing 4.3% of the developer energy. All right, number 5, DeFi remains popular and it's growing. So the only category attracting builders more than blockchain infrastructure is DeFi. And of course, I'm a big believer in this sector. So let's have a look here. Share of decentralized exchange spot trading volume. Okay, so DEXs, decentralized exchanges, if you don't know what that is, think of something like Coinbase, which is run by a bunch of humans and has a corporation. Imagine there isn't a corporation, there's just a bunch of smart contracts that exist on a blockchain, and they run an exchange like Coinbase. Everything is robotized. Everything is decentralized. There is no company. In some cases, there's a company like Uniswap, there's a company, but there are many DEXs, decentralized exchanges, otherwise known as DEXs, that there is no company. It's just a website, front end, and a bunch of smart contracts, and you go plug your wallet into it, and you can trade coins. So this is the volume of trading that has gone on these DEXs. So crypto trading is increasingly happening on DEXs. So 169 billion is now locked inside thousands of DeFi protocols. And here's how sort of the breakdown goes. So liquid staking. So you want to stake your Ethereum and then delegate that to miners of Ethereum in the validators in the Ethereum proof of stake network. You can make a portion of the fees, the transaction fees that the validators make. So this is a useful, you're getting paid basically to help provide security to the Ethereum blockchain, which is a useful thing. So you should get paid for that. And you're doing it by lending your Ethereum to a validator as their it's a proof of stake network. So that's the stake. So that's the money that they put up, like sort of in a safety deposit box that says we're not gonna cheat. We're gonna not lie about transactions. So this is it's great passive income. It's about 4% annually, generally most of the time, that you can make on Ethereum. So liquid staking is you stake your Ethereum on one of these platforms, and they give you back a token, which is sort of like your coat check for the Ethereum that you've staked with the network. And that token is now liquid. So you can go and put it in other DeFi protocols. You can sell it. You can stake this staked network, this liquid staking token. You can restake somewhere else. So you can kind of, create inception by staking the coat checks from the various things in other things to get another coat check to stake it somewhere else. So your money can be making you more money and getting yield in multiple places at one time is kind of the way to think of it. So liquid stake is the most popular. Lending like Aave, so that's exactly what it sounds like. So decentralized finance, you have entities which loan out money or loan out crypto, and you have to put up usually about 2x worth of collateral to make sure that your collateral doesn't go below the amount that you borrowed, right? So these things have remained solvent pretty much always. This even during the crashes of FTX and Luna, these lending protocols all held up very, very, very well. So which was sort of lost in the story of all the destruction fest. DeFi worked. DeFi worked really well. So Aave is still around as well as most of the lending protocols. So that's a big sector. Bridging, so WBTC, roughly 1% of all Bitcoin has been locked into WBTC. So that's a way to put your Bitcoin from the raw native Bitcoin chain to bridge it into a wrapped token on the Ethereum blockchain, which allows you to use Bitcoin on the Ethereum chain. So that is a very popular usage of DeFi. And then there's a bunch of other things. The DEXs, decentralized exchanges, restaking, that's that sort of inception of staking that I described earlier. And then just a mishmash of other stuff. Okay. All right, now they talk about Ethereum completing its transition to proof of stake. The amount of Ether, so there's 100% of Ether of that. 29% of it is staked in proof of stake validators to help secure the network. And that's up from 11% 2 years prior. So that greatly enhances the security of the network. Why? Because 29% of the coins are available to be slashed if there are dishonest validators in the network. So, if you lie, you lose 1 million. Well, that sucks, but you only lose 1 million only. But it's definitely a lot better than if you have 1 billion that will get taken away from you if you are dishonest. So your motivation to be honest has increased quite a bit if $1 billion is on the line versus just 1 million. So that's basically what they're saying there. While still in its early stages, DeFi presents a hopeful alternative to the trend of centralization and power consolidation affecting the U.S. financial system, where the number of banks has dropped by 2/3 since 1990, and where an increasingly small share of big banks dominate the assets. So what they're saying here, we all remember the Silicon Valley bank collapse, right? It was horrible. It was most of Silicon Valley banked at Silicon Valley Bank. So when that bank went under, if it hadn't been bailed out, it would have been an extinction level event, like quite literally, for all of Silicon Valley, all the venture capitalists, all the companies. It would have absolutely wiped out Silicon Valley in one swell swoop. So it's pretty bad to have one point of failure like that. And right now we sort of have that, 5 banks, Chase, Bank of America, Wells Fargo, my old eyes can't see what that one is, and US Bank, are roughly 50% of the banking system. So just because they're all buying one another and consolidating, that's bad. So DeFi decentralizes and creates more and smaller concentrations of liquidity and power. So that, basically the idea is that the more decentralized and the smaller the little pockets of money are, the stronger we all are as a financial system, because our finances are, there's not one place where bad people or bad things can happen. It's the blast radius will be contained to a small area, as opposed to if one of these big banks goes under, that could be super bad. So now here's the market cap of the NASDAQ. We're kind of seeing the same thing happen in the NASDAQ here, where you have 5 or 6 companies are dominating 50% of it. So there's great risk of centralized failure in both of these things. Point number 6, crypto could solve some of AI's most pressing challenges. So AI is one of the hottest trends of the year, and there's pretty big overlap between crypto and AI users. About a third of the crypto projects, 34%, say they're using AI regardless of the category in which they're building. So I don't know how they're using AI. That's a bit of a mystery to me, and they don't really go into it here. I assume they mean AI is assisting in the coding, or they're building AI into the product. Like, for example, I know that Masari, their pro and enterprise products now have a chat GPT for crypto, which is updated in real time, where you can just talk to it and ask it anything you want about what's going on in crypto, and it'll answer in complete sentences the way ChatGPT does. And it's extremely knowledgeable. It's a specialist in crypto, right? So its training data is specifically crypto. It'll know about things that broader AIs like ChatGPT won't. They're clearly a crypto builder project, which has used AI in their offering, right? So that's another example. Also, given that the cost of training frontier AI models has increased 4x per year over the last 10 years, we believe that AI could trend towards increasing centralization of power. So I mentioned this earlier. About a year and a half ago, Jason Calacanis famously said, and said this to me privately, said, you should pivot from crypto to AI. And, Jason's a very smart guy. So anything he says, I will listen to it and I will investigate it. And so I did. I did think for a couple of days about it pretty deeply. And I did investigate what was going on in AI quite a bit more than I had up until that point. My impression was that it was sort of the inverse of crypto, in that AI favors, because of the GPU and the training data required to make AI, it greatly favors the very centralized and the very big. And the more complex the training data and the GPU required to crunch the training data gets, only very few companies can really afford to compete. So that means, unless you're Amazon, unless you're Tesla, unless you're Google, you might as well not compete, because you're just going to get rolled over by these big behemoths. Now, crypto is exactly the opposite because of its inherent decentralization. The smaller, nimbler players in the little speedboats can compete better than the big giant players in their giant battleships. So it favors the very small and the very nimble, and it doesn't favor the very big and very centralized. So it's interesting, as you mash up crypto and AI, they're sort of opposites. So how do they fit, and how do they fit? And the contention of a16z is basically by having decentralization, you have something like Linux that can occur, right? So during the operating system wars of the 90s, you had IBM, you had Apple, you had Microsoft pouring billions into trying to create the dominant operating system. And who won that giant war? Linux, the open source alternative, which was decentralized and which had sort of the big world all working on it at once. And also it was free, right? So you might have the same thing happen with AI, where you have all these big players stumbling all over each other to get to dominance. Meanwhile, a crypto-powered decentralized network might be much bigger than all of them. And in fact, the Bitcoin blockchain is already dwarfs all of them in terms of the amount of GPU it uses and will use for the next 5 years. So, blockchains and decentralized protocols absolutely can win this AI battle. No question about it. It's already winning. Bitcoin alone is already beating it in terms of GPU. So these are some areas that a16z calls out. Basically, all these images we're seeing that are AI, how do we know whether they're made by humans or whether they're AI generated? In the BitTensor universe we just had on, subnet 34, which is, I'm spacing the name, what was it? Yes, Bitmind. Bitmind is subnet 34 on the BitTensor Tau blockchain. It specifically, you feed it in an image and it spits back whether it was made by AI or whether it was made by humans. So that use case is one they call out, and that's only going to increase as the proliferation of AI images swamps Twitter and elsewhere. And then they talk about some of the other use cases. Training compute for AI models has increased 4x over the last 10 years. One of the other guests we had on recently was Subnet 33, Ready AI, which is all about tagging training data for ingestion by AI frontier models. So if you basically have humans kind of provide metadata, the AI can ingest the training data quite a bit better, right? It can contextualize it quite a bit better. And now Ready AI is able to do that with a 600x, not 600%, 600x cost savings over scale AI, which is using humans to do it. It uses AI to do the same thing. And it has a 71% greater accuracy than its human-based competitors. So again, that's a decentralized model attacking a centralized entity successfully at rather small scale already. All right. 7.7, more scalable infrastructure has unlocked new on-chain applications. So, there's, because blockchains are faster, because they can handle more transaction volumes, that means new use cases like, imagine Twitter decentralized where every tweet is a transaction. You couldn't really do that on Ethereum because it only lets you do 21 transactions per block. But on something like Solana, which claims, I don't know if this is really true or not, but they claim that very soon you'll be able to handle 1 million transactions per second. You could theoretically, and if each transaction is a tweet or each tweet is a transaction, the new Solana could theoretically handle that kind of tweet volume. So new types of applications are now possible, just weren't before. Social networks are another example. So now they're talking about what I just referenced. 10% of the projects are social related. Remember, not a very big category right now. It's less than 1% right now. But 1/10 of the crypto projects in the developer energy is headed in that direction. So that's a pretty good indicator of where the value and the future activity will be. Farcaster, of course, being one of the big hot ones in that sector. Games, we saw Axie Infinity kind of rise and fall, and now they're theoretically rising again. And they're I still believe games. Somebody's going to crack games. There's going to be a big crypto game at some point. Just hasn't happened yet for whatever reason. Prediction markets, we're in the middle of the election cycle right now. So they talk about Kalshi, but the big one everyone uses is Polymarket, which is on Polygon. And that's because of the speed of Polygon and some other characteristics of increased stability and increased capacity on Polygon. Polymarket is now possible. And of course, in the election season, now we have $2 billion bet on the presidential race. So that just simply wouldn't have been possible on the old Ethereum, which could only handle 21 transactions per second. It would have been laughable. You couldn't have done Polymarket over in that universe. So we're going to hopefully see a whole new wave of innovation because of the increased capacity. And that's it. That's been a16z's State of Crypto report. My name is Mark Jeffrey. This has been Hash Rate. Hope you enjoyed it. And that's it for me. Talk to you all soon.